Now let's talk about Starbucks. The global coffee giant is making a retreat in China. It's handing over control of its China business. So who is buying out Starbucks now? It's a local private equity firm called Boyu Capital. Together, they'll run a joint venture. Boyu will own the majority of the business, which is 60%. Starbucks will keep the other 40%, and it will continue licensing the brand. But the message is clear. Starbucks is stepping back. This is one of the most recognized brands in the world, a symbol of Western consumer culture. And now it's becoming the latest global giant to retreat from the Chinese market. So what went wrong? Let's break it down. First, the basics. Starbucks entered China in 1999. It opened its first store in Beijing. Since then, it expanded rapidly. Today, Starbucks has around 8,000 outlets across China. For years, the company saw China as a key growth market. But that story has changed. Sales have slowed, costs are rising, and local players are getting stronger. That's not just a Starbucks problem. It's a wider trend. Western companies across the board are struggling in China. This includes names like Apple, Volkswagen, and LVMH. They all have struggled to boost their sales. Let's look at the earnings of American and European players. In 2021, they earned $670 billion in China. That was 15% of their global revenue. By 2023, revenue dropped to $650 billion. And the China share slipped to 14%. It's a small dip, but a steady one. And enough to worry global boardrooms. A survey by Bain & Company offers more insight. It spoke to 166 CEOs and COOs. Back in 2022, 55% wanted to leave China. They were thinking about shifting operations. By 2024, that number jumped to 69%. That's a big shift. And it raises an important question. Why are so many companies pulling back? Reason number one, local competition. Chinese companies are now dominating key sectors in the auto industry. Local brands sell 69% of all cars. That's nearly double the share from just 4 years ago. The same trend is playing out in food and drinks. Starbucks' biggest competitor in China is Luckin Coffee. It's a local brand. It sells a latte for 9.9 yuan. That's about $1.40 and less than 1/3 of Starbucks' prices. Then there's Mishu, a homegrown ice cream and drinks chain. It's pulling customers away from global brands like Häagen-Dazs. That's to its cheaper offerings. These aren't just budget brands. They are local, culturally rooted, and they are connecting with Chinese consumers in ways global brands are not. Reason number two, changing consumer behavior. Shoppers in China are becoming more frugal. People are cutting back on luxury spending. They are turning to discount platforms like Taobao. They are choosing cheaper, local alternatives over premium imports. This price sensitivity is hitting big brands hard because they are built on high margins and not discount pricing. Reason number three, economic and political headwinds. China's economy has slowed, consumer demand is weak. Add to that the ongoing trade war, the American tariffs, and tighter regulations on foreign companies. All of this has created an environment, one where global brands find it harder to grow and easier to leave. That's where Starbucks comes in. The company is optimistic about the joint venture. It says it will help reshape its business in China. It is selling the idea as a long-term strategic partnership. But the numbers tell a different story. Starbucks isn't expanding in China the way it used to. Local brands are faster, cheaper, and more popular. So instead of pouring in more investment, it is handing over the reins and keeping a smaller stake in the game. This is not a full exit, but it is a reset, a sign that even the world's most powerful brands have limits in China.
Want the facts?
The latest developments?
News that gets straight to the point.
Well, we've got all three just for you. This is Firstpost Live, a brand new show, your window into what really matters.
Don't miss it.